Hi, I'm Henry, the AI avatar of Henrik Eckenberg. Let me ask you a question. Have you ever been in a trade that went against you and you thought, if I just buy a little more down here, I can lower my average and get out at break even when it bounces? If you have, you've fallen for the single most dangerous temptation in trading. It's a siren song that feels smart in the moment, but has destroyed more trading accounts than almost any other mistake. Today, we're talking about why you must never average down on a losing position. We'll look at the psychology that traps you, the brutal math that proves it's a losing game, and most importantly, what the world's best traders do instead to protect their capital and live to trade another day. Stick with me, because the framework I'm about to show you is the bedrock of professional risk management. There's a quote from hedge fund legend Paul Tudor Jones that every trader should have engraved on their desk. He said, "Losers average losers." It's blunt, but it's true, and he's not alone. Mark Minervini, William O'Neill. The titans of this industry built their careers on ruthless risk management. Ignoring this core rule isn't just a financial risk. It's an invitation for emotion to take over your decision-making. So what is averaging down? It's simple. You buy more of a stock as its price falls, hoping to lower your average entry price. It whispers in your ear, "Hey, the bounce is coming. Buy more now and you'll make even bigger profits." But here's the reality. For a swing trader who relies on momentum, averaging down is a complete breakdown of discipline. You're not stopping the bleeding, you're opening a new wound and doubling your risk. The psychology of a bad bet host. So if it's such a bad idea, why is it so tempting? It comes down to a few psychological biases that are hardwired into our brains. First, you have the sunk cost fallacy. This is our tendency to stick with something just because we've already invested time or money into it. That initial trade is a sunk cost, and our brain tells us we have to make it work, instead of just admitting we were wrong. We get committed to our initial idea and start looking for reasons to prove we were right. Second, and this is the big one, is loss aversion. Studies have shown the pain of a loss is about twice as powerful as the pleasure from an equal gain. To avoid the sharp, definite pain of closing a trade for a loss, traders will do almost anything, including making a bad situation worse. Averaging down feels like you're turning a loser into a new, better opportunity, but all you're really doing is delaying the pain and making it bigger. Let's forget psychology for a second and look at the cold hard math. Imagine you buy 100 shares of a stock at $50. Your total risk is $5,000. You're expecting a quick move up, but it doesn't. The stock drops to $45. Your position is now down $500. Instead of taking that small manageable loss, you decide to average down. You buy another 100 shares at $45. Now your position is 200 shares and your average price is $47.50. It feels better, right? You only need a small bounce to get back to even. Wrong. Look at what you've actually done. Your total capital at risk has almost doubled from $5,000 to $9,500. And if the stock keeps falling, which it often does because your initial thesis was wrong, the losses compound exponentially. A drop to $40 now results in a $1,500 loss, 3 times larger than your original planned risk. You've turned a small cut into a potential hemorrhage. This is the exact opposite of what professional traders do. They risk a little to make a lot, not the other way around. What the pros do. Instead, the framework. Okay, so if averaging down is out, what do you do when a trade goes against you? The answer lies in a disciplined framework you establish before you ever click the buy button. It's 3 simple steps. To get exclusive access to the full version of this presentation, we invite you to share it with your network. Post this video on social media, tag Ahar Heckenberg, and we will provide you with a link to the complete content as a thank you for joining our community.